Hey everyone, Douglas here, Candid Market Analysis, and pretty wild day today in markets, and it is May 23rd, about 10:30 p.m. as I'm recording this, and we saw a lot of volatility today, really on the back of what seems to be some deteriorating trade negotiations between the U.S. and China. So what I want to do in this video is talk about just that, and I've also been wanting to try something new, kind of a new video format, which is more of kind of a hot take, vlog style update. So we'll see how this goes, and I might experiment with this style in the future. But anyway, let's jump right on into the discussion. And like I said, I want to discuss those escalating, seemingly trade wars now with China, and hopefully offer kind of a fresh, unique perspective on these talks. And what I want to do is try and view the U.S.'s monetary, trade, fiscal relationship with China through a lens of MMT, or kind of a heterodox model. And you could really summarize it as kind of a flow of funds view, if you will. So that's what I want to try and pull off. And look, there's a lot of hype around these trade talks, a lot of fear, lots of volatility. We saw the selling today. And whenever it looks like these talks might fall apart, we start to see selling. And ultimately, from how I assess the markets, from how I model the macroeconomy, a lot of this fear, especially from the viewpoint of how these trade talks and possible trade wars may impact U.S. equity prices and the economy, I really see it as being misplaced. So there's a lot of angles we could discuss this and view this from either the tariffs, the trade deficit, and those are all important topics, and I'll possibly pose some real risks going forward. But what I want to focus on right now, at least in this video, is this worry over China's massive holding of U.S. bonds. This idea that we're trillions and trillions of dollars in debt to China, and that because of this, China has some sort of upper hand. And I keep seeing different headlines, not only from kind of the more sound money crowd, the conservative sources, but also from like the Financial Times, CNBC, Bloomberg, all these big names. They're all talking about how China has some like nuclear option that they could choose. That China could go scorched earth and sell the 1 point whatever trillion dollars of bonds that they have, and that this would somehow put the U.S. in some fiscal death spiral going forward. Or I mean, it tends to be kind of the hypothesis that I see out there. But here's the thing. I don't mean to be overly critical here. Maybe I do. I don't know. But this take, this view that China can hold the U.S. hostage with its debt holdings, it really lacks a fundamental understanding of monetary and fiscal operations. And interestingly enough, it happens to be that kind of same crowd that completely misunderstood QE when that occurred, in the same crowd that doesn't understand why China's treasury holdings are not really a threat to the U.S. And I know that connection might not make any sense, but it's there, and I think you'll understand why I brought it up and how you can actually make that connection. And I'll tie it all together at the end of the video. So let's do this. I think if we look at this topic of Chinese treasury holdings, right, again, like I said, through the lens of how funds flow, through the lens of modern monetary theory, I think we're going to see kind of how misplaced these worries are, at least with regards to Chinese debt holdings. And I think we might even glean some interesting insight along the way with regard to kind of how China is going to act in their selling of treasuries and that sort of thing. So let's do this. How about I just put it this way? How about I just put it bluntly and kind of provocatively say that despite what you hear, the U.S. isn't actually in debt to China. And I say that, and what I mean by that is we're not in debt to China. The U.S. is not in debt to China the same way that you or I might be in debt if to a bank if we had a mortgage. And to kind of wrap our heads around this, one question you might want to ask yourself to try and start down this flow of funds path, if you will, is that question would be, where did China, or how did China end up with all these treasuries in the first place? How did they get these bonds in the first place? And the answer is that they bought them. It's the same way that you or I would have ended up with treasuries if we had them, right? We would have bought them. And second question, the next kind of logical question to ask yourself is, how did they buy them? How would we buy them? Well, with dollars, right? U.S. dollars, just like you or I would. The Treasury certainly wouldn't expect, or certainly wouldn't receive yuan for the Treasuries, right? They are purchased only with dollars. So the next question, building on this kind of flow of funds idea, is how did China get dollars in the first place to buy the bonds? Well, they earned them. It's the same way that you or I would get dollars, right? Now, China earned them by selling lots, or them, the US dollars, by selling lots of goods, and we're willing to receive dollars in payment for those goods in the tunes of trillions of dollars. And just like you or I, when we receive dollars as payment for whatever reason, if we have dollars, we have one of two choices on what we can do with those dollars, right? We either have to spend them or we can save them. And China has the same decision to make. They can spend their dollars that they receive, or they can save them. Now, for monetary reasons, for monetary goals, for long-term kind of national goals, China chose to go ahead and save them, right, to build up the large dollar reserve balance. And they have good reason to do this. It's prudent for their economic aim as a country. So once you make that decision to save, now you just have to make another decision, just like you or I would if we decided to save. And that decision is where you're going to keep them, where you're going to put the dollars to use. You could keep them as dollars, right? But you'd risk kind of devaluation over time, maybe inflation, that sort of thing. You could invest in stocks or some sort of equities, something like that, and that might be a good idea for you and I, but not a terribly liquid option for trillions of dollars like China. And then obviously there's a lot of risk there as well. But another option would be bonds, right? And it would be a risk-free interest rate on the bond, and an incredibly liquid market. We'll kind of discuss why it's infinitely liquid in just a second. And this really meets the need of China and their long-term monetary goals. So, bingo, that's how China ends up with a huge stash of bonds. They bought them because they earned the dollars, and they wanted to keep those dollars in savings for monetary reasons. And 50 years ago, Japan started doing the exact same thing, and many other countries have gone down this route as well. It's not China's not the first one to do this. And that's really what bonds are, right? They are nothing more than an interest-bearing savings account, really, for dollars at the Federal Reserve. They're not debt in the same way a mortgage would be debt, right? China accumulated them the same way that we would accumulate them, and had to make the same decisions along the line that you or I would make. So it's not like a mortgage home debt, like I was just saying, and at the end of the day, China, when they had dollars, what they did, unlike you or I, they actually would call up the Federal Reserve, and they'd say, hey, instead of dollar reserves at the Fed, because that's where they're going to end up, I'd like to buy bonds. And that's it. That's the entirety of the process. So going back to this kind of analogy of buying a home with a mortgage and debt, how it would work with you and I, right? When we're doing that, I'm bringing, like, let's say I wanted to buy a home, right, and I was going to get a mortgage. I'm not bringing anything to the table, right? I have no money for this operation. I might have a down payment, but for this example, it's not relevant, but right. But I want a home, right? That's what I want, and the seller of that home wants money. They want cash, right? I don't have cash, but we still want to make this transaction happen. So what happens is a bank is going to step in between us and facilitate the loan, right? And what are they doing? The bank, they are actually creating money out of thin air. Topic for another time, but they're creating the money, and as a deposit for the home seller. Okay, this is important. So the money gets created as a deposit for the home seller, and they create the money as a loan for me. The loan being my liability and the bank's asset, and then the deposit being the bank's liability, and then the home seller's asset. So now all three of us are happy, right? The transaction has been completed. I have a home and a mortgage, so maybe I'm not actually all that happy. The bank has a loan as an asset, right? That'd be my loan, and an offsetting deposit, which is the cash asset. So the cash now for the home seller, who no longer has a home but now has cash. So big takeaway there is I have an asset. I have an asset as a home, but I also have a debt, right? And it's a real debt. I have to now go earn dollars and pay those dollars back because the bank has to have more assets than liabilities, and since their only asset at this point is my loan, they need me to pay it back so they can have the depositors when they come back and want to pull some of the cash out. They can have cash on hand for the deposit, but it's basic. It's basic accounting. There's needs to be an offsetting asset, and for an offsetting asset for the liability. So now going back to the debt that China is holding, there's no bank that is originating a loan between the U.S. and China. There's obviously the Federal Reserve, but they're not really originating a loan. The money already exists. It existed because the U.S. spent it into existence in the first place. And the sellers of goods and services accepted those payments, right? In this case, China. The U.S. Treasury, when it spends, it does not need some sort of offsetting asset. In fact, it would kind of make no sense to have an offsetting asset from a balance sheet operation standpoint, right? Because to have an offsetting asset would cancel out the very money spent to begin with. There wouldn't be any money in existence if the U.S. needed to be paid back the way a bank does. And this is why thinking of the national debt in terms of kind of the debt you or I might have to, say, buy things will completely throw you off and lead you down the path that many in the sound money crowd will go down. They are literally on the complete opposite sides of the monetary coin, if you will. So what will happen if China decides to dump all of their treasuries at once? Likely nothing. Maybe some headlines, maybe even a few hours of panic, but likely nothing. What would end up happening is they'd go to the Federal Reserve, they'd call up whoever they have to call up and say, hey, essentially they're going to say, hey, please debit my securities account and credit my reserve account, and the Fed would do just that, and there would be a swap of assets. In fact, to kind of tie this back to that QE point, right, and this is kind of the silly part of it all, at least if you were observant of the last 10 years of history, this would, hopefully make some sense, that this is kind of what QE is, right? Because all QE was a swap of assets at the Fed, right? It was the Fed buying up trillions, almost 4 trillions, 4 times more than China has in treasuries, in bonds, and replacing those bonds with bank reserves, essentially dollars, right? And do you know what happened after QE? Quite to the chagrin of the Fed, actually not much, right? I mean, we did end up with higher bond prices, and that was kind of one of the things they were aiming for, so lower rates, and we did end up with a higher dollar, and likely it priced equity prices higher as well. But in the grand scheme of things, at least in terms of the goal of what the Fed was trying to do, not all that much happened after QE, and definitely not any runaway hyperinflation or fiscal or some crashing dollar or fiscal turmoil or anything like that. In fact, the opposite in many ways of each one of those worries ended up happening, and this is why so many people went down that route of some sort of fiscal doom right around the corner when QE happened, and the same thought process is going to take you down a path of fiscal doom with the Chinese treasury holdings, because it lacks a fundamental understanding, a flow of funds, an MMT, whatever you want to call it. It's lacked that thought process is lacked, and a modern understanding of how money works is just not operating in that theory. So here's the thing to kind of tie all this back to the markets today, to the now, to the recent selling, and I know this whole China debt narrative makes some good headlines, and for the perma bears makes for kind of a compelling argument for a big collapse. But I'm just not buying it. Look, I've been long these markets actually since December 26th of last year was when I went ahead and made the switch. I had been short the market or in cash kind of prior to that for the prior few months, but on December 26th, 2018, for actual data-driven reasons, for stock flow consistent reasons, for applied modern monetary reasons, it made sense to get long. And understanding those principles, combining them with kind of the more classic global macro principles, it really painted a clear picture at the end of the year last year that this bull market still had a lot longer to go. And today, despite the fact that we are definitely seeing some weakness, there are definitely more risks today than there were 5 or 6 months ago. Despite that fact, I still think the bullish case can be made. And I know, at least for now, I'm looking for a recovery from the recent selling and likely a break to new highs, to much higher highs than we saw recently. So here's the thing. Here's what I'm going to do. In the description below, I'm going to go ahead and put a link to the macro update that I posted on the day after I went long, so December 27th, 2018, 5-6 months ago, that laid out the bull case back then for why I thought we were going to go higher. So if you're interested, you can check that out and kind of see how I went through that. And then if you're interested, just last night I posted on my Patreon page my weekly macro update where I made my bull case once again and even highlighted some possible bear signs as well. It's an objective process. You have to look at all sides, at all data points. But if you're interested in that update, head over to the Patreon page, patreon.com/KennanMA. Obviously, the link will be in the description below as well. All right, so I'm going to go ahead and wrap up this video here. If you're not yet subscribed to my YouTube channel and you like what I'm doing, make sure you hit that subscribe button and turn on notifications as well. I'm going to be trying to make a more concerted effort to to start getting more updates posted here on YouTube. So if you don't want to miss those, like I said, subscribe. And if you found this video particularly helpful, make sure you hit that like button as well. Anyway, that's going to be it for now. So yeah, good trading everyone, and I'll see you next time. Bye-bye.